Welcome back, folks. This is going to be the review of examples number 9, 10, and 11 in my Optimal Trade Entry Pattern Recognition series on YouTube. So this is the details for the example number 9, which was Euro Aussie. It was a short, and the example was found on May 19th, 2020. The chart's already trained in on the 5-minute chart. So we have the optimal trade entry in here. Previous day's low, Monday daily low here, and you can see initially we shot down in here just shallow, as I mentioned in the YouTube video, but there remains a portion of sell side liquidity resting below these lows now. So when price was trading down, we had one more attempt to trade below. It was shallow again below Monday's low. And then we rally back up into the optimal trade entry, 70.5 level. Now, as you can see here, the fib is drawn on the wicks and tails. So I want to refine it a little bit with some of the principles that we cover in the mentorship. And I want you to focus on the bodies of the candles. Okay, before I do it though, look at the levels that it calls for. Now, there's nothing inherently wrong with this level. It's just I like to be a little bit more precise. And I taught this approach to using the fib on my YouTube channel, and a lot of people watched it and made fun of it because they don't understand it. But once you see what I'm doing with it, it takes you right to the heart of what's really going on, and it demystifies everything. Even though it looks different, which is what makes it strong, we're looking at the bodies of the candle, the highest up close or the highest opening price. Okay, so either way, you use this one or this one, not that one, Michael. There you go. So it drops down, pick up the bodies there, and it trades right back into optimal trade entry. And now look at the negative standard deviation of 1. So look at the projected low. It's calling for 1 standard deviation. It's 1.630 and 1 pipette, and the low comes in at 16628 and 1 pipettes. So it's less than 5 pips deviation, which is what I always say. We're going to look close to the daily high or daily low within a 5 pip variance, and that's going to be because of the broker's feed, and they offer in-house liquidity that's always going to skew the data. Also, Monday's low, if we take a projected range down, negative 40 pips, it takes us to that level as well. So we have layered liquidity in the form of sell side liquidity below these lows in the form of 10, 20, 30, and 40. 50 pips is fine, but we can get this run here and then use limit order to cover with 5 pips above that or 10 pips above that, and that would give us a much more handsome exit point. So let's move on over to example number 10. This is an Aussie dollar pair. Alright, so here's the Aussie dollar. We already have our chart trained in on the 5-minute, and it's the 20th of May. Okay, so we're going to take a look at the Australian dollar. This is the May 20th long optimal trade entry. You can see that was shown here in the YouTube channel. But now I want to show you the difference of what I like to see here. We have this low to this high, all of this price range in here. Use the low to that high, make sure it's on the swing, okay, and it takes us up to 1.5 standard deviations at 66 and 16 pips, and the high comes in at 66 and 16 pips. It's only off by 4 pipettes. Beautiful by itself. And now if we calibrate our fib, we're going to use the highest body and the lowest body right there, and it comes in at 0.66, 16, and 2 pipettes. And again, the high comes in at 66 and 16 with 4 pipettes. So it's only off by 2 pipettes there. And again, with the confluence of 30 pips above Tuesday's high. Here's Tuesday's high. You can see here at the high comes in at 65.85 right there, and 10 pips above that would be 65.95. 20 pips would be 66.05, and then 66 66.15 for 30 pips above Tuesday's high, taking us up here for confluence there. And again, 15 pips above the 66 big figure takes us to that level at 66.15 as well. And just a beautiful run. Now you might not have looked at this right here as a potential optimal trade entry, but this is nested optimal trade entries. Okay, so you have a run here, it retraces, a run here, and it retraces. But look closely, you have a fair value gap there as well, and this price run in itself is an optimal trade entry, but the parent price swing begins from here and then extension up into the target for the buy side liquidity resting above Tuesday's high. Alright, finally let's move over to example number 11. This is a dollar CAD pair for May 21st, and it's a long. Alright, so here's the dollar CAD. We already have a chart trained in on the 5-minute chart and on May 20th of 2020. New York session in here. You can see the previous day's high right back here. It's Wednesday, May 20th, so Thursday, May 21st. See, we have, again, here's the high, and we're going to project that up 20 pips above previous day's high, takes us to this level exactly. And in here, this is the optimal trade entry I outlined. Again, much in the same vein I said with the previous example, when you have nested optimal trade entries in here, by itself this is handsome, there's nothing wrong with that. And if you did another half a standard deviation up, it would take you right to that anyway. But watch what happens. We're going to take our fib, put it down on this price leg here to here, and we're going to walk it out so you can see the optimal trade entry. Okay, so wick to tail, and or rather tail to wick rather. Optimal trade entry, price runs up. Projected high is 139.70 and 3 pipettes, and the high comes in at 139.70 and 5 pipettes, so it's only off by 2 pipettes. Now if we refine this to use the bodies in here, and then walk that out, beautiful. Standard deviation 2, 139.69 and 8 pipettes. If it's going to go there, it's probably going to reach for the nearest 10 level, and you can see it does in fact do that at 39.70 and 5 pipettes. So just beautiful market symmetry. Everything in the chart is now refined to a degree that is more mentorship level. Now if you take this fib off, and we're going to go back and look at this a little bit, you have a institutional order flow entry drill right in here. This candle's low, trades down below that, expansion above, and then targeting the intraday high, and it runs through that as well. So hopefully you found these insightful, and until tomorrow, which we won't do any of the examples in tomorrow's video because it's a midweek review, so we'll do a little bit of teaching on that. There's people out there just recreating my video and mimicking what I'm doing on the things. That's why you hear music. All of you have in individual groups now, you have a different track playing, so please don't email me telling me that it's distracting. It's there for a reason, so that way when people are letting my audio play and they're mimicking what they're doing on their chart, I can hear the song that's playing in behind it, and then that will also act just like a watermark, like you see here, the watermark. Everyone, you have a different watermark in your group, and you all have a different track playing in the background too. So again, unfortunately we have to go through all these things, but I don't mind doing it. I don't mind doing it because it's going to pay out. So I'll catch up with you tomorrow. Until then, I wish you good luck and good trading.